Well, ladies and gentlemen, welcome back to Boss Economics World, the only show that takes the chaotic dumpster fire of global finance, sprinkles it with data, douses it in satire, and serves it up hotter than a Wall Street trader's temper tantrum after a bad earnings call. I'm your host, the one, the only, economic overlord of sarcasm, here to break down the madness of markets, the folly of policymakers, and the sheer absurdity of it all. Buckle up, folks, because today, we're diving headfirst into the economic circus of August 2025, where central bankers, AI chip meltdowns, and political meddling are serving up a buffet of dysfunction so rich, even Gordon Gekko would blush. First up, let's talk about the main event, Jerome Powell's big moment at the Jackson Hole Symposium, where the fate of global markets hangs on every word, pause, and eyebrow twitch of the Fed chair. Traders are on edge, folks, paring back bets on an imminent interest rate cut faster than you can say quantitative tightening. Asian equities? Barely moving, up a measly 0.2%, while Chinese stocks are popping off like it's 2015 all over again, up over 1%. Treasuries? Yuan, inching higher, with the 10-year yield dropping a single basis point. And the dollar? Holding steady, flexing its muscles like it's auditioning for America's next top currency. Meanwhile, the Taiwan dollar is on a 7-day losing streak. Someone get that currency a coffee, it's clearly exhausted. But here's the kicker, folks, markets are acting like Powell's speech is the economic equivalent of a Marvel movie premiere. Will he be the dovish hero, swooping in with rate cuts to save the day? Or the hawkish villain, crushing dreams of cheap money with a single data-driven quip? Spoiler alert, if recent Fed chatter is any indication, don't hold your breath for a dovish blockbuster. Cleveland Fed's Beth Hammack basically said, rate cuts? Nah, fam, not tomorrow. Atlanta's Raphael Bostic is out here predicting one measly cut this year, while Kansas City's Jeffrey Schmidt is screaming, inflation risks are still the big bad wolf. Even Chicago's Austin Goolsbee, usually the chill one, is side-eyeing the data, hoping that one dangerous inflation blip doesn't turn into a full-blown horror movie. And let's not forget the S&P 500, folks, which is on a 5-day losing streak down, like a bad karaoke performance of Sweet Caroline. Why? Because the US economy is throwing mixed signals like a teenager texting their crush. On one hand, jobless claims are up, hinting at a cooling labor market. Boo-hoo, Fed, time to cut rates, right? Wrong. On the other hand, the factory PMI is booming, growing at the fastest pace since 2022. Translation? The economy's too hot to handle, and traders are slashing their bets on a September rate cut from 90% to 70% faster than you can say dual mandate. Now, let's zoom out, folks, because this isn't just about Powell's speech or the Fed's latest mood swing. This is about the deeper, juicier economic issues bubbling under the surface, issues so spicy, they'd make even the most stoic economist sweat. Let's break it down, Boss Economics World style, from point to surface, with a side of satire and a sprinkle of the latest data to keep it real. First up, let's talk about the Fed's eternal frenemy, the dual mandate. For those of you new to the game, the Fed's job is to keep inflation low and employment high, basically, to be the economic equivalent of a unicorn, delivering magical stability in a world of chaos. But here's the problem, folks, right now, inflation and unemployment are pulling the Fed in opposite directions like a dysfunctional couple on a reality TV show. Inflation? Still sticky, with the latest CPI data showing U.S. consumer prices rising 3.2% year-over-year in July 2025, well above the Fed's 2% target. Meanwhile, unemployment? Ticking up, with jobless claims hitting 245,000 last week, the highest since mid-2024, signaling a labor market that's starting to wobble like a Jenga tower in round 10. So, what's a central banker to do? Cut rates to juice the labor market and risk inflation spiraling out of control? Or keep rates high to tame inflation and risk a full-blown recession? It's a lose-lose, folks, and the Fed knows it. Just look at the latest Fed minutes. Officials are citing elevated uncertainty over tariffs and trade wars, which, by the way, are back in the headlines thanks to our old pal, Donald Trump, who's out here demanding a 0.5 percentage point rate cut like he's ordering a Big Mac at the drive-thru. Spoiler alert, Don, the Fed doesn't take orders from the White House, but nice try. And speaking of tariffs, let's not forget the global angle. The US isn't the only one grappling with inflationary pressures. Over in Japan, consumer inflation is clocking in at 2.8%, well above the Bank of Japan's 2% target, fueling speculation of another rate hike before year-end. Why? Because global growth is starting to surprise to the upside, folks. The IMF just revised its 2025 global GDP growth forecast to 3.4%, up from 3.2%, driven by strong manufacturing data in the US and Asia. But here's the catch, stronger growth means more inflationary pressure, which means central banks worldwide are stuck in the same hot mess as the federal rate cuts? Maybe not so fast, my friends. Now, let's pivot to the tech world, where Nvidia, the darling of the AI boom, is serving up some serious drama. Shares of Nvidia slid 1.9% in pre-market trading after reports that the company told suppliers to halt production of its H20 AI chip. Why? Because of US export restrictions tightening the screws on China, that's why. Meanwhile, Chinese chip stocks are soaring like they just won the lottery, up double digits on the news. What's going on here, folks? It's a classic case of geopolitics meets economics, with a side of corporate chaos. Here's the deal, the US has been cracking down on China's access to advanced AI chips, citing national security concerns. The H20 chip was Nvidia's workaround, a less powerful version designed to comply with export rules while still raking in billions from the Chinese market. But now, even that's getting the axe, and Chinese firms are scrambling to fill the void. Just look at the data. China's semiconductor output jumped 40% year-over-year in Q2 2025, according to the China Semiconductor Industry Association, as domestic players like SMIC and Huawei race to close the gap. Meanwhile, Nvidia's China revenue, which accounted for 17% of its total sales in 2024, is now at risk of evaporating faster than a puddle in the Sahara. Poor Nvidia, caught in the crossfire of a tech Cold War. But here's the bigger issue, folks. This isn't just about one company or one chip. It's about the global supply chain, innovation, and the economic fallout of decoupling. The US and China are locked in a high-stakes game of chicken, and the collateral damage is real. Just look at Taiwan, the semiconductor capital of the world, where the local currency is on a 7-day losing streak. Why? Because investors are spooked about escalating tensions. And let's not forget the latest data from the World Bank, which estimates that a full US-China tech decoupling could shave 0.8% off global GDP by 2030. That's $1 trillion in lost economic output, folks, enough to make even Jeff Bezos blink. And now, for the cherry on top of this economic dumpster fire, political meddling in the federal. That's right, folks, the Justice Department is reportedly sniffing around Fed Governor Lisa Cook, with some Trump allies calling for her ouster over alleged mortgage agreements from 2021. Meanwhile, Trump's housing finance chief, Bill Pulte, is out here demanding a full-blown probe. What's next, folks? A reality TV show called Survivor, Federal Reserve Edition? Now, let's be real here, this isn't about mortgages or ethics. This is about politics, plain and simple. Trump has been gunning for the Fed's independence since day one, treating Powell like a personal punching bag and demanding rate cuts like a kid throwing a tantrum in a candy store. And he's not alone, politicians worldwide are increasingly meddling in central bank affairs. Just look at Turkey, where President Erdogan's interference has turned the lira into a punching bag, down 30% against the dollar since 2023. Or India, where the Reserve Bank of India is under pressure to juice growth ahead of the 2026 elections, despite inflation ticking up to 5.1% in July 2025, per the latest RBI data. But here's why this matters, folks. Central bank independence isn't just some nerdy economic concept, it's the bedrock of financial stability. When politicians start meddling, you get short-term gimmicks at the expense of long-term stability. Just look at the 1970s, when political pressure on the Fed led to runaway inflation, peaking at 14.8% in 1980. Or take a more recent example, Argentina, where central bank interference has fueled hyperinflation, with prices rising 115% year-over-year in 2024, according to the IMF. The lesson? Keep politics out of monetary policy, or you'll end up with an economic horror show. So, what's the takeaway, folks? We're living in a world of uncertainty, where central banks are walking tightropes, tech giants are dodging geopolitical landmines, and politicians are playing with matches near a pile of dynamite labeled financial stability. The Fed's in a bind, torn between inflation and unemployment, with markets hanging on Powell's every word. The US. China tech war is heating up, threatening global growth and innovation. And political meddling is eroding the independence of central banks, risking long-term chaos for short-term gain. But here's the kicker, folks, this isn't just about numbers or charts, it's about you. Your savings, your job, your future. So, stay sharp, stay skeptical, and keep watching Boss Economics World, or we'll keep calling out the madness, one sarcastic quip at a time. Until next time, this is your economic overlord of sarcasm, signing off.